Hello, and welcome to the April edition of the Corporate ESG 5 and 5 podcast, the podcast in which we spend 5 minutes exploring the 5 key ESG trends set to shape the market this month. I'm Dan Bressler, Climate and ESG Capital Markets Corporate's Vice President, and I will be taking you through this month's key trends. We'll start on institutional developments. The EU Platform on Sustainable Finance provided recommendations on the social taxonomy. They propose to keep the structure of a social taxonomy close to the structure of the green taxonomy. The social taxonomy would therefore define social objectives, types of significant contributions to these objectives, and it would also clarify the criteria to determine that these objectives are not significantly harmed. Objectives in the social taxonomy would be based on the type of stakeholders that could be affected by economic activities. These include a company's own workforce, capturing workers along the value chain and end users, as well as communities that are affected by economic activities directly or through the value chain. Moving on to disclosure, the Task Force on Nature-Related Financial Disclosures, or TNFD, unveiled the beta version of its framework to help corporates better understand and disclose nature-related risks and impacts. The framework follows a similar approach to the TCFD, aiming to give companies and financial institutions a more complete picture of how to think about environmental risks. It currently consists of 3 main components: key science-based concepts and definitions, disclosure recommendations and guidance on how nature can be incorporated into enterprise risk and portfolio management processes, and it also outlines the intricacies of how nature varies based on location and proposes location-specific disclosures. The SEC proposed new climate disclosure regime for public companies. According to the SEC's proposal, disclosures of Scope 3 carbon emissions will depend on how material they are to a company's business. Disclosures will be required on how and how often companies purchase carbon offsets to neutralize some of their emissions. And the SEC said that new requirements would be phased in over several years. The largest companies would need to start disclosing climate risks for the fiscal year of 2023 in 2024, and other firms would have to report for the first time in 2025 based on their 2024 reporting year. Companies will get an extra year beyond those dates to include supplier and customer emissions and to get the emissions data audited. The next steps are for the public to have 60 days to submit comments on the proposed rules, and then those comments will be taken into consideration before issuing a final rule, which will then be voted on by the SEC's 4 commissioners. Within sustainable primary capital markets, we've seen a few interesting transactions. Pernod Ricard issued the first sustainability-linked bond in the wine and spirit sector, suggesting an openness from companies that are sometimes subject to investor exclusionary policies to consider ESG-labeled financing. This follows other recent SLB issuances from the tobacco and mining sectors. The Pernod SLB focuses on 2 of their most relevant environmental areas, according to Sustainalytics: greenhouse gas emissions, Scope 1 and 2, and water consumption. While the framework also includes a longer-dated Scope 3 target, and the introduction of the framework includes acknowledging the importance of conveying responsible drinking, there are no KPIs on these aspects in the bond. Another interesting primary capital markets issuance was from Fortescue, an Australian iron ore mining company, and they issued their inaugural 10-year green bond. This issuance marks the first labeled bond from the mining sector in 2022 and adds to the growing number of high-yield issuers in the ESG-labeled space. The Sustainable Finance Framework from Fortescue lists excluded projects to specify to investors which expenditures this financing does not apply to, including any expenditures related to fossil fuels. Finally, on the investors front, BlackRock released a report saying that at least 75% of their investments in corporate and sovereign issuers are expected to have science-based targets aligned to net zero by 2030. BlackRock noted that right now, around 25% of its assets under management have science-based targets, and that this figure is expected to rise based on projections of the rate at which these issuers will adopt these targets in the interim period. Thanks for listening to this month's Corporate ESG 5 and 5. I hope you found it useful. As always, please be sure to check our monthly newsletter, linked in the description, for more on the key ESG trends shaping the market this month. And if you like this episode, please follow the channel and click the notification bell so you can get future episodes as soon as they're released. Thanks again and see you next time.